big market drops like today's can create big bargains for investors, specifically value investors. So we're joined by one right now. Scott Black is the president of Delphi Management based in Boston. He has over 30 years experience in the financial market. Scott, great to have you here. Help me make some sense of what we're seeing here. I mean, we saw a lot of selling in Europe. It continued in the United States, and it didn't seem like that there was any place to hide here in this market. You've seen a lot of declines. What do you think about today's dramatic decline here?
Well, I think this is a vote of no confidence. You know, we squandered 3 months with partisan bickering. We got a bill that didn't look anything like Simpson Bowles. It didn't follow the guideline of raising some revenues and making better cuts, maybe the $4 trillion reduction over time. It was really like putting Band-Aid over cancer, plus the fact we haven't paid attention to what the real problems are in the country. You need a pro-growth agenda on the business side, and we need to put Americans back to work, and we haven't really done that. And that's what's happening here. It's just a vote of no confidence. So,
Scott, do you think it's all U.S.-centric? We talked with Mike Arenstein earlier, and he said it's not the United States. It's really the debt crisis over in Europe. What do you think? Is Europe part of it, or is it mostly the U.S. here?
Well, I think Europe exacerbates the situation. But if the United States were running close to, a fiscal deficit close to zero, like in the Clinton years, and public debt to GDP was 48% as opposed to 97%, we wouldn't be in this box we're in today. I think a lot of it is U.S.-centric.
So how do we get out of it? I mean, is it a quick fix in your view? I mean, it sounds like everybody agrees, even the politicians themselves, they screwed this one up big time. How do we get out of it and quickly and provide some reassurance to the markets? You know better than anybody. I mean, confidence is crucial to the economy and the markets.
Well, I think you got to call an emergency session. Ben Bernanke on the Fed and Geithner. I wouldn't be surprised now if you see a QE3 or at least a de facto QE3. We're going to have to keep an accommodative monetary policy because of the fiscal strictures in this deficit. We don't have a lot of room. I mean, GDP revenues are only about 14.8% now. The government spending's 24.8%. You got a huge gap. There's not a lot of flexibility. You're going to have to address gross private domestic investment to make it more corporate friendly, perhaps employment tax credits, something along those lines. And you know, we talked about shovel-ready 3 years ago. We should have been putting more people in America, rebuilding the infrastructure. Still, a job is the best social program.
But, I mean, come on, Scott. I mean, how likely are we going to get any of this and quickly? Because it doesn't seem like what they had a month. They had months, actually, to figure out this problem in Washington, and they didn't do it. They took it right down to the last few seconds here. How likely is it that we're going to get any of this, in your view?
Very, very unlikely, because you have the extreme right, which is the Tea Party, and unfortunately Boehner had to cater to them, and you have the extreme left. And unfortunately, we have too much of a partisan divide, so I don't think it's going to be a unified concordance in the short term. But I do think that people are going to revisit the budget deficit. They are going to look at the Simpson-Bowles guideline, and I think we may see a better result, but that's not going to help the market overnight.
No, absolutely. What do you expect is going to happen in the market tomorrow? We've got the jobs report. There's not very high expectations here. What do you expect, and do you expect that the market could take another significant leg down potentially here?
Unfortunately, this thing feeds on news and momentum, and I wouldn't be surprised to see more of a correction. I mean, if you look at stocks as a whole, the S&P is 12 times earnings, going to earn over $98. It's cheap by any statistical measurement, but there's too much of a fear factor out there, so I don't see any catalyst to make it rally in the short term.
Scott, you out there buying? You're a value guy. I mean, I'm assuming you like when these stocks get beaten up. You know, you get a better deal here, but are you guys out there buying?
We have been the last few days, and the kinds of names we've been buying for clients, a company like Oracle, earnings 30% on book, straight up record, tough management, has over $2.70 in excess cash. It's essentially selling at 10 times next year's calendar earnings. Another stock that, if you're certainly patient, is one of the great values of all time. Berkshire Hathaway today closed at 1.1 times book value. And, of course, if you know Warren Buffett, what he stresses is book value per share and its growth. It's continued to have grown over 10% compounded the last few years. It's a terrific entry point. I can't tell you that Berkshire's not going to go down tomorrow, but it's a terrifically good company.
Scott, you know, let's talk a bit more about Berkshire, because it's been underperforming the S&P over the past year. I mean, there's no buy ratings on it. I'm assuming you don't really care, you know, necessarily whether or not there are. But I mean, why is Berkshire having such a tough time here?
It's a good question. I know they got financial services and the insurance business, but Burlington Northern is good. You know, it's a different company than it used to be. They have Mid-American Pipelines. They have a cutting tool business in Israel. There's a lot of diversification in manufacturing, energy, all sorts of businesses. Yes, he still has the 4 core holdings in terms of American Express and Coca-Cola, Procter & Gamble.
Right.
But it's not getting much respect. But the net asset value per share continues to grow nicely, and that's the measurement that Warren Buffett has always used in terms of ascertaining the success of his business.
Hey.
And at 1.1 times book, it's a steal.
Hey, Scott, just got about 20 seconds here. I mean, you've seen a lot of market moves. You nervous here about this one, or you feel like, all right, it's another drop, we'll get out of this pretty easily?
You know, you have to believe in the long-term success of the United States. You know, we've had other swings over the past few years. We had 1982, October 19th, 1987. The sun sets and the sun rises every day. The United States is still the greatest nation in the world, and we have, you know, energetic population, entrepreneurism. Notwithstanding the morons that run Washington, the people will do a good job, and ultimately, you know, the sun will rise again on the U.S. stock market. There's reason for hope.
Scott, I always like your optimism. Thank you so much. You take care.